Hi there and welcome. My name's Chris Cann with Aspermont and MiningNews.net. We're at Mining News Select in Perth, and with me I have Phil George from Entrust, part of the Euroz Hartleys team. Phil, thanks for joining us. We're reading a lot of research at the moment from a variety of investment banks, institutions, etc., and the scenarios that might play out in the markets from a macro perspective. We're looking at potentially a soft landing, maybe a hard landing, potentially no landing at all. How are you reading it at the moment?
Yeah, you're right, Chris. And I guess what's driving all of those scenarios is, can economies hold together post what's been a pretty aggressive period of rate rises? And you're right. I mean, there are those three different scenarios that may play out in markets. I guess from our position as advisors building diversified portfolios, we think it's too risky to try and position your portfolio for one of those outcomes. We think a far better strategy is to be positioned and ready for all three of those scenarios. And maybe if I can just touch on what those three scenarios are again, just briefly. So a soft landing would be where global economies are able to maintain a growth rate that's above trend, employment markets hold together, and then interest rates just gradually move their way back to target. A no landing scenario would be where growth stays strong, employment markets hold together, and we just kind of live with higher inflation. A hard landing scenario would be that interest rates tips economies over the edge. We see mass unemployment and growth really slows. Look, we kind of feel as though rather than subscribing a probability of all three of those, we think there's 100% probability that all three of those scenarios are likely to play out at different phases. So I think it's important to get a sense of where we think we are, and so that we can be planning ahead for what phases might lie ahead. And I guess if I take us back to October, November last year, that was the first sign that maybe we'd seen the high point in rates. So we saw some inflation numbers come out of Europe that suggested that inflation number was generally rolling over. That was a cue for equity markets to rally, and interest rate markets were pricing cuts at that point. So I feel as though that might have been the soft phase of the landing. We very quickly, come say February, March, moved to a scenario where it looked like getting economies back to target was going to be a lot harder than we thought as far as the inflation numbers were concerned. But the economies were holding together, and so was unemployment. Employment markets were really quite strong. So we're now potentially in this somewhat extended phase of a no landing scenario. But we think that probably raises the prospect of ultimately there being a soft landing results at the back end of this, because I think if rates are higher for longer, I think that just makes it harder more generally. So we're taking advantage of this sort of melt up in markets, I suppose, to rotate some of our holdings and to lean slightly into higher bond yields for defence.
Okay, that was going to be the next question, Phil. Like, how do you position yourself when you're talking about that no landing scenario for an extended period? Yep. And my interest would be, when you say an extended period, any danger of actually getting some timeframes on that?
Zero chance I'll give you time frames on that, Chris,
okay.
As much as I would love to. But,
very reasonable.
Yeah, but I suppose, and maybe if I can deal with equities first, exposure there. We feel as though we need to be running what we might refer to as a barbell strategy there. We think the opportunities there for investors, if they've been lucky enough to own the big technology companies in the US, compelling opportunity, we think, to take a little bit of profit off the table there, and then go and look for some really defensive names, probably in the Aussie market. Okay, so we're liking to build a more defensive, more robust equity portfolio where yield is probably going to be a big contributor to the total return. So that's one thing we're doing. We have lifted our cash a little because we think there's going to be opportunities to participate, but at the same time we need to own those deep cyclical material businesses as well, because if we do see the soft landing, we don't want to be have no cover to growth. So deep cyclicals, good time to own some more defensive assets in the equities part of your portfolio. And as I say, bonds have been kind of under-owned for probably best part of the last decade, and you can get some compelling returns in some short-term high-grade credit as well. So there are alternatives to being just long stocks.
And this is your second Mining News Select Perth.
Yes.
What have you made of this year's event?
Great. Well, I mean, just walking through the doors again this morning, blown away by how busy it is. Looking forward to some of the panel discussions later this morning. And I've got a heap of meetings lined up with some of the delegates and exhibitors here this afternoon. So looking forward to getting across a few more projects than I was kind of a couple of days ago.
That's the idea of it.
Yeah.
And from what you've seen so far in terms of some of the content, any of the conversations that you've been having on the sidelines, any key takeaways?
Yeah, it's good. I mean, clearly, I guess there's still a lot of talk around demand coming from this energy transition. Gold prices, is pretty topical at the moment. But probably the difference from last year is I think businesses are feeling like they're getting some relief on costs.
Phil, thanks so much for your time.
Thank you, Chris.